Good afternoon, everybody. It's August 13th, 1:30, and we're joined by Adam Collins of Movement Capital. He's going to be joining us every week to discuss interesting occurrences in the CoT report, breaking down, how things are looking and different interesting patterns that might help us make some trades off of that information. He also has a lot of great seasonal information. So, Adam, welcome.
Hello, everybody. So first thing right off the bat is this is not investment advice. And if you didn't catch last week's webinar, what I mainly do with COT is give it some context. So it doesn't matter if, speculators are long or short, 50,000 contracts. You need to know if that number is extreme or not relative to the past. And my solution is quite simple. I just make a 5-year percentile of it. So if it's 100%, it means that trader category is more net long than they've been over the past 5 years. And if it's 0%, that's sort of like they haven't been that pessimistic in 5 years. So let's dive into the data, what's changed over the past week. Specs have definitely capitulated out of the long copper trade. They're still net long, but positioning has gone from like net long 5 billion to net long less than 1 billion. And so that was a bit of a washout because you can see that as copper got above 3, it got more popular as a trade. People piled in, and then it was a pretty complete rug pull. So that was sort of a big positioning unwind. Gold definitely gets a lot of. I've noticed a lot of people talking about gold positioning right now, and it's honestly as extreme as people say, which is rare. But speculators are definitely not optimistic on gold in the least. We're very close to 5-year lows in net spec positioning, and this is that graph of the percentile I talked about. So you can see the white line, speculative positioning. It's right at 0%. So it means that traders haven't had this low of net long exposure in gold futures in nearly 5 years. And to put some context on the positioning data, here's two different ways to look at it. On the left, we've got this isn't spec positioning, this is commercial positioning. So this is looking at, mines that produce gold and sell futures to hedge, and the people that use gold and buy futures to hedge. And on the right-hand side, we do have spec positioning. So it's typically yin and yang. They go opposite of each other. So on the left, you can see that, okay, so net commercial positioning in gold hasn't been this net short in a couple years. And you might look at that graph and say, well, wait a second, they're almost always net short. It's because producers dominate hedging activity in futures markets. Just because, if you're a user of a commodity, sometimes you can sort of pass on the price increases. But if you're a producer of it, typically you're highly leveraged. And, if you're the case of a gold miner, they know they hemorrhage money below a certain price. So there's more of an incentive for producers in commodity markets to hedge. On the right-hand side, we can put a dollar amount on the current net spec position. And so it's right at $1 billion exactly. And it's interesting that over the past 12 years, traders actually haven't been net short gold ever over that time frame. And so I really wouldn't be surprised, especially after today's price action, if this Friday's COT report shows traders being net short for the first time in more than a decade, which would be that's truly extreme positioning. And then we've got an example of what an extreme spec positioning unwind can look like. Now, remember, I talked last week about how a lot of people, when they approach COT or positioning data, they immediately want to fade it. They hear that, for example, they look at a gold chart like this and say, oh my God, everybody's on one side of the boat. I want to go the opposite way, buy some gold, right? And I don't think that's a proper approach, because put yourself in the mind of somebody who right now is short gold. They are not really feeling the pain. Like the trend is going their way. They have a minimal incentive to liquidate the position. But when you can combine crowded spec positioning with price action that goes opposite of how people are positioned, for example, in gold, if the rest of the week gold ripped 8%, pressure. So that's more of an actionable setup than just extreme positioning. And then this is an example of what can happen when everybody gets caught, on the wrong side of the boat when position's extreme. So it happened in lumber earlier this year. It was a crowded trade for months. So for honestly most of 2017, and people were trying to fade that, and I didn't think that was the proper thing to do. And then finally, lumber fell under heavy pressure. And when trades like this turn, it's not a 5% correction. It's typically a pretty large move. And you can still see that position in lumber, it hasn't completely washed out, but it's definitely not as extreme. So silver is sort of interesting because it's nowhere near as extreme as gold. It's low. I mean, speculators are definitely, not super optimistic, but gold's definitely more extreme than silver. So palladium fit within the precious metals. Similar story. And in fact, with palladium, sort of interesting because Palladium went on a tear last year, and from like the 2016 lows to the 2017 highs, it was more than 100% move. It was a very large move. And as you'd expect, such a big move, a lot of trend followers got, a part of it. And it's the exact opposite, positioning picture right now. Went from a very consensus long in fall 2017 to now very few people are long Palladium. Platinum, even more so. Platinum is more extreme than Palladium. So if I'm looking at the like the white line on this, traders are definitely not that long platinum, but they're extremely pessimistic on platinum. I misspoke a second ago. And on the flip side of that trade are hedgers. And when you see something like producers and users, that sort of 5-year percentile being really high, here's what you can infer. What it means is that there are not a lot of platinum miners who are looking at the current price and saying, "Oh, I want to fix, selling costs for the next 2 years here." But there are platinum users who are looking at the price of platinum and saying, "Oh, the price is very low. I want to lock in future inventory costs." And for example, in platinum, users are manufacturers who use platinum in catalytic converters for cars. So that's a big use of it. So let's look at crude oil, probably the most popular commodity of all. It's been written about for a while, but spec position is quite long. And in fact, it's getting more interesting to me now because, crude's been trading weak. And that's what I was talking about is when you can sort of combine extreme spec positioning with price action and putting people under pressure, that's sort of what you're getting in crude right now. And spec position is still very net long in crude. In dollars, it's north of 40 billion, which is close to the like the 2014 highs. So we got wheat, which is interestingly enough the number one most crowded spec net long trade, meaning that it's a consensus long trade among speculators. And it's interesting because that's not the case with most agricultural commodities. Wheat stands out as being the really crowded ag trade. Let's look at currencies. So of all these charts, you'll see a common thread in that speculators on average are quite net short foreign currency. So they're implicitly, long the USD. And that's the case in the Australian dollar. Spec positioning is probably at 2-3 year lows. And so they're net short around 60% of the open interest, which is historically significant. Turning to the yen, it's sort of been a back and forth with yen positioning where middle fall last year, it was a pretty consensus short. And then it reversed overnight when the yen rallied. Then everybody got long. And then we're back to where we were a year ago, where positioning is not extreme, but people are definitely leaning short the yen. Euro is not the crazy crowded long trade it was a couple months ago, but there's still substantial long interest in euro. Swiss franc is probably the most interesting currency to me, and that the spec position is by far the most extreme in it. So, for example, right now, traders haven't been this net short Swiss franc futures relative to USD over the past 5 years. And the positioning is almost as extreme in the New Zealand dollar. So, when you look at all these charts, they're different charts, but it's the same message. It's that specs are all in on a long USD trade. And if that were to come against them, you'd probably see some pretty rapid short covering. For example, in the New Zealand dollar, where traders are net short 70% of the open interest, which is a massive figure. Turning to stocks, we've got Japanese stocks. Specs freaked out in fall, winter last year in the Nikkei, and it was a good trade. It popped around 10%, but then traders came back in, and it's a pretty consensus net long. This is one of my favorite charts. It's looking at 3 contracts: the E-mini, S&P, NASDAQ, Dow, adding together the net spec position and everything, and then putting a dollar value on it with the multiplier for each contract. And it's definitely come back in earlier this year, January. Net positioning hit around 130 billion, which was just like a monster figure. And we've come back a lot. We've come back probably 70 billion. which is, so like an absolute level, they're still quite net long, but it was a very quick reduction in net long exposure. And then we've got, this is just the S&P, not an aggregate. And I talked about it last week, but it's interesting to see, the S&P rally close to all-time highs and the net spec positioning substantially come off. And to me, there's sort of two ways you can slice this. You can think of it this way. You can think of, okay, if we make all-time highs, you've got a lot of people who puked out who are going to feel stupid, who have a big incentive to come back in, right? But on the flip side, look at what happened in summer of 2015. So you would sort of think that spec positioning probably peaked in like, May, June, July of summer 2015. That was right before the Chinese, mini devaluation. But that's not what happened. So in the S&P, specs were super, super bullish in like late 2014, early 2015. What I'm getting at is that before the August 2015 big correction, spec positioning wasn't that extreme. It was sort of like this long, protracted reduction in long positioning, and then there was like this rapid puke in August. And it's sort of a similar setup right now in that we haven't made new all-time highs. Spec positioning has come off. As you can see, the absolute level of positioning is still substantial. Like there's still lots of long exposure out there. And so, I'm personally torn on the way to interpret this, and I would probably defer to price action of if you make new all-time highs, you're gonna have lots of probably fear of missing out. People have pulled exposure, have got to get back in. But if we don't, if we fall under more pressure, there's still 60 billion or more, because they can even go net short, that could puke out. So here's sort of my most important charts. This is all the contracts. So this is for spec positioning in commodities. What's crowded, what's not. Left-hand side, crowded longs. Right-hand side, crowded shorts. Like I talked about, wheat on the left-hand side is the number one most crowded long. And since that percentile is 100%, it means that traders haven't been this net long wheat futures in 5 years. On the right-hand side, we got the crowded shorts. And it's nuts. Gold really is probably the most consensus, it's the most pessimistic spec trade right now, closely followed by coffee, platinum, and some of the livestock contracts. So here's same metric, spec positioning, but in financial futures. So there's not really any extreme longs. I define extreme as a 5-year percentile either greater than 90% or less than 10%. And there's nothing like that on the long side. On the short side, two trades stand out. Definitely the New Zealand dollar and the Swiss franc against the USD. Traders are very short those two currencies. And then this isn't looking at specs. This is looking at hedgers. It's sort of the inverse of this chart. So where hedgers bullish or not, or that's sort of the wrong word to say, but basically in coffee, platinum, natural gas, the stuff on the left, they're positioned for higher prices. Producers aren't hedging a lot, and users are. And so on the right-hand side, there really aren't a lot of contracts where hedgers are, quickly getting, net short. And so that says to me that on average, hedgers are biased to the net long side in commodities. So turning to some quick seasonal graphs. So this is looking at August seasonality for a bunch of different contracts over the past 20 years. And it's just taking average monthly performance numbers. So on the left-hand side, the highest performers. On the right-hand side, the weakest performers. So the number one best performing contract over the past 20 years in the month of August is the 30-year bond. And it's followed by some of the crude products like heating oil and gasoline. On the right-hand side, we've got the weakest performing contracts, which are S&P, Palladium, nat gas. So, August seasonality is what you read about. It's typically a bad month for risky assets like the S&P. It's typically a seasonally good month for stuff like 30-year yen, dollar, gold. And that's sort of interesting now that I look at it is, look at this. Okay, so we've got really extreme spec positioning in gold, right here where nobody's long gold. And then gold is typically done quite well along with other risk-off assets in August. That's sort of interesting. I also like to look at term structure in commodities, so the degree of contango or backwardation. And most commodities are in contango right now, but lumber stands out as being in backwardation. Crude is still a little bit. Crude's backwardation has come off. It was more extreme a couple weeks ago. And by the way, I look at this between the front month and the second month. And then contango is really, really steep in sugar and wheat. And so what that means is if contango is super steep and you want to have, long front month exposure, you're going to bleed by rolling that, forward if that contango stays the same. And then here's momentum. So this is just looking at 12-month roll adjusted price performance in these futures contracts. And I like to look at momentum because it sort of gives you a tell of how long-term trend followers, what sort of their bias is on these contracts. So for example, crude and heating oil are some of the top performing contracts over the past 12 months. So long-term trend followers or CCAs are still biased to the long side. And then on the flip side, on the right-hand side of this, we've got, sugar, coffee, soybean oil, platinum. Those are the contracts and steady downtrends where there's, still a lot of short exposure. So that was a brief overview. If anybody has any questions, I'm happy to answer them.
Yeah, Adam, as always, amazing information. And I find it really interesting that one of those last facts that you put up, how gold, in a way, something's got to give. It's historically short right now, but at the same time, August seasonality you show, typically there's a good month. So that'll be interesting to see. I see one question coming in is about why do you think that crude and gold, a lot of comments that you make are at extreme levels. Why is it that a lot of things are at extreme right now? Like even crude is a few bucks off the high. So why is it that you think, though, a lot of things are at extreme positioning these days?
It's a good question. I don't know why now. Well, to be honest with you, so check this graph out. Okay, so there's honestly not that much, not many contracts where there is extreme positioning. For example, on the left-hand side, there's one wheat. On the right-hand side, there's gold, coffee, platinum. And I mainly talk about the extreme stuff because that's where it gets interesting. But
I think they might be pointing out the fact that it's the dollar amount might be at extreme. And is it because just the market? I've heard you say before the market is larger now than it was 5 years ago, 10 years ago, 50 years ago.
Yeah, so that's part of it. But the thing with WTI is, so on the left-hand side, you can sort of see like the role of speculators over time. It's looking at the net spec position, dividing it by the total open interest. In plain English, 10 years ago, traders were a small amount of the market. It was more dominated by hedgers. Now, there's a ton more, people trading crude. And so for the graph to the right, it's interesting in that I think one of the reasons why positioning is extreme, specifically in crude, I think it's sort of residual of the big trend that started in 2016 is when you have these long, prolonged trends, you're going to incentivize a lot of people to come in. And it's also helped that we've had sort of this inflation narrative, right? Of where, CPI is accelerating. When people want to get inflation exposure, they put money into, commodity tracking funds. And those funds on average are like 50% crude. So that money's got to go somewhere. It's going to go in crude. And so I guess maybe one reason for why positioning is extreme in crude is because it's sort of been a bandwagon trade for people wanting inflation protection.
Interesting. One quick question. Bryn is asking, does this include ICE open interest as well?
No, so this is, well, yes, actually, because both ICE, CME, everything aggregates to the CFTC. And so I want to be clear, though, this WTI contract, this is a CME contract, and I've got similar stuff from Brent, like the ICE contract, but this is, what's on my screen right now is solely the CME WTI contract.
Interesting. What about natural gas as well? Like, because they have a lot of LME, a lot of ICE contracts.
Yeah. So there's a ton of nat gas contracts, and I sort of flirted with doing CoT data on those, but I realized that like few people would find that interesting. But yeah, I could reproduce what you see on the screen for every single regional nat gas contract, and the CFTC does disaggregate it into the regional contracts.
Interesting. Is there a dollar index chart? I know you were, and the dollar index isn't the greatest index. Somebody's asking that question because it's so heavily weighted in euros. And I know you pointed out Swiss and Kiwi, but do you have something just on the dollar index?
Yeah, I do. And I can pull it up. Let's see. We got it. Let me pull it up right here. Can you still see my screen?
I see your Twitter screen right now.
Yeah. Hang on, let me look it up. CoT data, currencies. So here's the issue with the dollar index contract. Nobody trades it. It's a super illiquid contract. And so I'll pull it up, but it doesn't tell us much.
Yeah, and it's like 56% euro and like 12 or 13% yen. So
Look,
it's euro and yen, and
yeah,
euro heavy.
right here you can see that specs are leaning long. But so here's the thing: you're right that when you look at the USDX, you're looking at euro, and so you're looking at this chart. And I think that's a big takeaway from positioning right now is that there's sort of there's this narrative out there right now as the rest of the world is not crumbling, but it's sort of like the U.S. is going to be the safe haven. We're going to win a trade war, et cetera. That information isn't valuable if everybody else has come to that conclusion. And people have when it comes to like their dollars because people are extremely short foreign currencies. And so I think if somebody steps up and says, you know what, I think, U.S. is going to come out on top a couple months from now, there's no value add there because everybody's already positioned for that scenario. And if that were to materialize to a less degree, and let's say, U.S. catches some damage, et cetera, the people who are innately long USD and short these foreign currencies are going to get hit. One last thing I definitely did want to talk about that's super relevant is, let's see, it's on here. So I posted this on Twitter last week, and I thought it was really important. Recently, I've noticed a lot of people are talking about how the 10-year is a very crowded short trade, that everybody's short bonds. And let me explain in 2 minutes why that is, at least it's not the case as it pertains to CoT data. So when people talk about CoT data, they always talk about this thing called the legacy report. It started in 1986. It's what people used, decades ago. In 2009, the CFTC came out with a new version of the report called the disaggregated report. And it was simple. It just broke it down into more categories. Previously, there were just commercials, non-commercials. Now we've got, leverage funds, asset managers. It's just a more transparent report. I'm sort of in the minority in that I use the disaggregated report. Most people still use the legacy report. Why does this matter for the 10-year? Okay, so look, in financial futures, the CFTC breaks down positioning like this. This is spec positioning in the yellow box. We got asset managers, slow money, leverage funds, fast money, other reportables, neither of these two, but they still trade size, non-reportable, small speculators. So these are sort of the four categories we're dealing with. If we look at the disaggregated report, so look, we've got long shorts for each category. We've got the net long, net short for each, and then we can get a net spec position. And this is for the 10-year contract. We can see that not only are speculators not net short, they're actually net long. And the most interesting charts from this is, okay, let me break down the sort of the net position by the category. We can see that asset managers, the blue line, think mutual funds, pensions, they're super net long. It goes complete opposite of what people are sort of repeating right now. And so slow money has massively bought the dip in treasuries. But on the flip side, leverage funds like CTAs, they are super short. And so this is a number of contracts. This is in net percent of OI, just a better measure. And so what I'm getting at, though, is it washes out. So you've got sort of mutual funds, slower stuff that are super long. You got sort of faster leverage funds that are super short. In the aggregate, specs really, they don't have that extreme of positioning in the 10-year. And then, like I said, there was one last tweet after it all. I sort of said, look, the big caveat is that when you're looking at CoT positioning for bonds, you're only looking at futures. Not only are you only looking at futures, or you're ignoring, the larger cash bond market, but if you're looking at 10-year positioning, all these bond futures are frequently spread. And so you're sort of looking at half the picture. And so, who knows what the true position is, but I just wanted to sort of dispel the narrative that traders are very short 10-year bonds, because they're not.
That's interesting. That's really detailed, and that makes a lot of sense. Can you confirm this? So basically, the CoT data you're reporting, everything that you just presented is based off of the latest CoT report, right?
Yep.
And the CoT report is based off of a snapshot as of the close of business on Tuesdays, but it's released
Correct.
on Fridays?
Correct. Yep.
Okay. One thing that's interesting,
Oh,
and
yeah.
actually, if you can go into it a little further, wheat just on its own, last Monday it looks like it traded 612 in the D suite, and now we're trading 572. It's actually off about 3% today, so that's good 6, 7, 8% off the high from last Monday, Tuesday. But on that wheat, right here it shows that it's an extreme position all the way on the left-hand side on the long. But then you also point out that historically speaking, like on the 5-year average, it's not that long. Is that right?
No, so with wheat right now, let me go to the individual chart. It's right here. Okay. So yeah, no. Positioning as of last Tuesday was definitely extreme. And so
Okay.
when that white line's at 100%, it means that speculators, when you take their net position and you look at it relative to the past 5 years, traders haven't been this net long wheat futures in 5 years. And when you combine something of where, as of last Tuesday, everybody was on one side of the boat, it's faded since then. Okay, so people under pressure. That's sort of that example of positioning and price action diverging, putting people under pain. I think that's the biggest takeaway of COT is you don't care just about extreme positioning. You care if it's actually hurting people, and that sort of is the case in wheat.
Yeah, and then you also had a chart, I think, on the hedgers, and the hedgers are not nearly, they're almost at historically, the hedging position, wheat's all the way on this far right extreme.
Yeah, it's not. I wouldn't define it as like super extreme, but definitely when you look at how hedgers are positioning, you've got more producers who are selling wheat to lock in the current price for their future production. So yeah, that's the status of wheat.
Gotcha. Well, as always, a lot of great information, amazing insight. Really interesting to see how this tracks. And like you said, we have gold here that is already had extreme short positions, and now today we're down 1.5%, which on recent volatility, this is a pretty significant down day. We're breaking through some pretty key levels. In DEES, we're right at 1,200, right, pretty much on the low here, down $18. So it'll be interesting to see how that continues to play out. But as you also pointed out, the seasonality has August as a pretty decent month.
I would say this, like in closing about position in general, but we can talk about gold because it's relevant. Okay, so when you look at this graph on the right, you see, wow, we haven't been here before. We've barely been here before with gold positioning, right? But look at this. So traders, they have a low net long position right now, but there is nothing from stopping them from going net short, like in size. And so with gold, I would say gold's been having horrible price action. And these people who are short, they're loving it. And there's no reason why you couldn't see this net spec position in gold just drip lower with the price of gold. And so to me, gold is interesting because we're sort of at, unprecedented levels of positioning. But when you talk about actual, actionable use of CoT data, something like WTI, where you've got a massive amount of spec long exposure, but price is weakening, similar case in wheat, those are what I'd actually be watching because gold is just still going the same way people are positioned.
Right. And then also, there's countless people that I've seen talking about how for risk-off reasons, buy gold as a safe haven. And then the other reason is simply based on the extreme over, what they call extreme levels of the CoT data. So kind of combining that, it's like, oh, buy some gold and, use a $5 stop or something like that. And that's also what feeds us lower and lower. That sort of thing is those kind of players, going long than stopping themselves out.
Yeah. Who knows?
So... Hey, but Adam, very interesting information. Thanks a lot for joining us. As always, a lot of great insight. Thank you.
Appreciate it. Thank you too.
All right.